Welcome to the XM.com weekly market update, and we're joined again by Pete McGuire. Good morning, Pete.
Good morning, Andrew.
And welcome back to Sydney.
Lovely to be here.
A couple of weeks in the Middle East.
Yes.
Which is very interesting times over there.
Certainly was. It was quite fascinating, geopolitically, naturally, and the economic situation, and you've got a spike in energy prices, all of these factors, and then the ongoing, I think, issues that could face us over the next couple of months, very protracted. If it's anything like Ukraine and Russia, this could be diabolical for energy prices, with the opportunity for possibly Iran to get brought into play.
For sure. Plenty going on, plenty of volatility. So we'll have a look at a few of these numbers. First of all, the Aussie dollar, it did dip below 63 cents last night, but it has recovered, albeit very slightly.
Yep.
But it's still under plenty of pressure.
Absolutely. Look, it's choppy. For short-term trading, 4 and 6 hours, and those windows, and the guys and the ladies, of course, run those technical analysis over that short time frame. They're getting plenty of movement, but you're not getting those explosive breakouts like that trend that we saw. If you put your mind back there to early July, where it just cratered down from that 69 handle down to 64, was that's what every trader wants. But at the moment, there are other markets that are offering those opportunities, and certainly the Aussie isn't one of them.
Yeah, that's right. We also had the labour data out this week. The unemployment rate is still sub 4%. It's around that 3.6, 3.7%. I think the main story that came out of the figures this week, though, there was quite a shift from full-time employment to part-time employment. So, which just tells you, it's sort of interesting, the dynamic there. Are people just changing their ways, or are they just preferring that part-time job, basically?
Oh, no, there's a third one, more important, and that is that companies are now saying you're 20 hours a week. You've gone from 40 because of downturn of economy, high interest rates, and the impact that has to the economy. And that's the great concern that we're hearing, is that the fragility on Main Street and that economic performance, what is the issue as far as survival for these companies under high interest rate environments?
Yeah, and which is interesting as well, because there's murmurings that the RBA might raise interest rates once again.
Yes.
And
before Christmas. Yeah, that'd be a present.
And you would sort of think that they probably have to if they want to sort of get that inflation rate down.
Yeah, and as we know, and you've only got to listen to them, and I mean, it's pretty. And until the Main Street really take on board the rhetoric that comes from central bankers, and that is that we need to see, and their words, certainly not mine, we need to see higher unemployment. What that means is that you're crushing companies, and that's your part-time.
Yeah, it's an interesting dynamic, that's for sure. Over to the UK, CPI number came out, still at 6.7%, very sticky. And once again, for the interest rate side of things, you would suspect at least one more rise would be necessary.
Yeah, exactly. And there's a chart that tells us a lot. And what I want to mention here is it certainly doesn't get reset at the start of the year, your CPI, year on year. What it is, it's cumulative. So that October figure there is year on year, 6.7%. Put your mind back to October 22, running at over 10%. It's 16%. So that gives us an idea what inflation's really running at, and it's terribly high.
And it's certainly tough on the economies.
Oh, well, that's where you'll probably see additional rate rises.
Yeah. And once again, will that support the British pound? Maybe not, because it's come under plenty of pressure in recent months.
Yeah, I mean, when you're thinking of that, I'm not suggesting we're going to get back to where we were, a best part of a year ago when it hit that real low level of 1.03, but there's every chance you're going to break 1.2 very shortly. That US dollar continuing uplift.
Yeah, the strength there, for sure. US retail sales came out this week, interestingly, up better than expected, and the revised number from last month was revised up as well. So, we've got the higher interest rates there. The consumers seem to be hanging in, but
that's
how long does this last?
Yeah, exactly. We've just got to, I noticed that does exclude automobile sales. And I know that the real estate industry is under a massive amount of pressure as far as headcount, first off, and then naturally higher interest rates and the impact that's having to the real estate market in the US. So all of these factors, some are ahead of the curve and others, probably like here, being the retail sales, are behind the curve, and will be interesting to see how we are at Christmas.
Yeah, that's right. Now, a few charts coming up. The interest rate chart in the States. This one, we normally just look at a 2-year chart.
Yeah.
This one goes back to basically pre-1980. The US 10s have just hit 5%, the highest level since 2007. And that's, you look at that rise in interest rates over the last sort of, 2 years now. And I know it's out there in the market saying it's the fastest rise ever in interest rates. And that chart certainly shows it.
Yes, it certainly does. And we spoke off air. I mean, I think that probably the next where you're going to run, because Powell's saying you probably have further rate rises, and we've got the issue they've got with treasuries naturally is once they issue those treasuries, someone's got to buy them. And there was a $20 billion sale in the last week, I understand, that was very, very poorly participated in. So they've got to get interest rates. The yields have got to climb for more interest. And so there's the trade-off. And are we going to see back to 2000 level as the next handle to break, that 6 to 6.3 sort of level? And you certainly don't want to go back to where we were early 80s under the Reagan administration and what they had to do there with Volcker.
Yeah, and no one wants that. But it's certainly, and these interest rates are certainly causing a lot of this volatility.
Yep.
Gold as well, plenty happening there for the traders.
Oh, yeah, it's been dynamic. It's been an incredible month. And we saw that big sell-off from 1980, then it cratered to 1830, and and people were saying, we're really going to see a downlift, and then all of a sudden you had that geopolitical tension in the Middle East. You've got ongoing sagas running across from economic conditions, and gold bounced, and it's been an almighty rally. So 160 down, 160 up. That's a $320 move. Our traders are absolutely loving it.
For sure. Talking about volatility, the oil price, which we've spoken a lot about in recent weeks, up, down, certainly has jumped again in the last sort of couple of days. And not surprisingly, all the tensions coming out of the Middle East, the volatility is going to stay there, and you would think these prices will continue higher.
Well, yes, they are, and we've got a lift. It's around about 92.38 for Brent. It's come back. It's given up a bit more horsepower, and you've got $90.30 for NYMEX. Now the issue is again geopolitical. If Iran was to get involved in this, then this is what everyone's worried about: the contagion effect to energy prices. And as we know, a great proportion, about a third of all oil, travels through the Strait of Hormuz. And what would that do as far as distribution and supply would be just annihilated. So that's what we don't want to see. And I think this is going to be a very protracted situation between Israel and Palestine. So I just sit here and go, okay, 100's probably on the table and very shortly.
Yeah, and I think you're right. There's probably not going to be a short-term solution to the conflict there, that's for sure. So,
no.
And once again, we know financial markets love stability, and we haven't got a lot of that at the moment.
No, we haven't.
So,
and that's that market sentiment, and that's that undertone that you want to have. And it'll be a very interesting. I keep on saying it to you and to our viewers, but it'll be an interesting run up to New Year's Eve. What is going to happen over the next 2 and a bit months? We're still now about 54 weeks away from the US election, and it's starting to warm up there as well.
Yeah, plenty going on, that's for sure. So.
Oh yeah, and do we see a change of batter as far as Biden?
Well,
this is what they're saying. He can't win. So is it time now to pull the plug on him?
Yeah, make the move.
And so this is going to be fascinating how those US politics play into it as well.
Certainly is. But plenty going on and plenty of data coming out. So we'll keep an eye on things over the course of the next week. And
I'm looking forward to it.
Regroup again next week.
Yeah, I just want to say that we had, I was in Fujairah, and the oil conference that I attended there, the Secretary General of OPEC was there. He spoke. And the forecasted numbers moving forward, around about 116 million barrels a day of consumption in the next 20 years, currently at 100 million. So it just shows our addiction to crude oil. So whilst you've got prices going up, you say, well, maybe there's going to be demand destruction, and people say, well, I don't want to buy crude oil anymore. There's only one way it's going as far as momentum. Also, you've got mobility of youth, and you've got electricity demand, which is monstrous.
Yes.
So... and that needs to be powered.
Yeah, especially in those developing countries where a lot of people are coming out of either poverty or rural areas into those more
agrarian
urban,
societies.
Yeah.
Like I was in Mumbai and there's 20 odd million there. I was in Cairo over the weekend, 23 or 24 million there. It's the size of Australia in a city.
Yeah. Huge. But yeah, plenty going on. So we'll catch up again next week.
I look forward to it.
Great. Thanks, Pete.
Thank you, Andrew.
And that's the xm.com weekly market update.